My name's Andrew Culpin. I'm a tax associate partner at Hurst and Co in Stockport. Hurst and Co are a firm of accountants based in Stockport and also with offices in Liverpool. We're about 60 strong employees and 8 partners. We provide pretty much a wide range of accountancy services: audit, accounts preparation, tax planning, corporate finance, business risk consulting. In my opinion, the key to successful tax mitigation is to plan strategically throughout the life cycle of a business. And we've got 5 illustrations of how that would work in practice for a business. The first example is for businesses which are looking to grow, and one of the key challenges for such businesses is to attract and retain key employees. One of the best and most tax efficient ways of doing that is to offer such employees shares or share options. And one of the most attractive at the moment is to offer share options under the Enterprise Management Incentive Scheme. The Enterprise Management Incentive Scheme allows businesses to offer share options in their company up to £100,000 in value. It's an inland revenue approved scheme, which means that after just 2 years of owning the share options, an employee could potentially sell those shares and just pay tax at the rate of 10%. The second area is again for growing businesses, as such businesses will often be looking to attract investment. Again, they should look at maybe attracting investment through tax efficient investment schemes such as the Enterprise Investment Scheme or Venture Capital Trusts or the Corporate Venturing Scheme. The third area is for businesses, particularly those with older shareholders, and thinking about succession planning. So what's going to happen when the original owners look to retire from the business? Such businesses really need to be planning as soon as possible how they're going to structure that exit. Are they looking to transfer shares to family members? Are they looking to sell the shares? Are they maybe looking for management buyouts, management buy-ins? The sooner that such businesses get those plans in place, then the easier it is to actually mitigate any tax that may arise on the strategy that they put in place. The fourth area to consider is when you're actually looking to exit from the business, so maybe sale or maybe passing on to the next generation. It's important to start planning early to ensure that you do mitigate the tax that you will pay on exit, and in particular to make sure that you qualify for business assets taper relief. Business assets taper relief is a capital gains tax relief which ensures that after just 2 years of ownership of an asset, you can sell that asset and pay tax at an effective rate of 10%. The final area to consider is once you've exited from your business and you've got the cash effectively, and then the important issue is estate planning and what do you do for the future. It's alarming the number of businesses and businessmen who don't have wills and haven't put any planning in place for what they would do in the future, or if anything happened to them. The most important thing for businesses to do on a day-to-day basis is actually, in my opinion, to be in constant contact with the professional tax advisors. One final piece of advice I'd always give to business people is to ensure that they've always got documentary evidence for everything they do. If the Inland Revenue do decide that they're going to inquire into the tax affairs, it's obviously then that much easier to make their case with the revenue if they've got the necessary documentary backup to prove what's happened.